Hello and welcome to the IPEM Wealth 2025 edition here in Cannes as we explore the latest trends in the industry. How is the market doing? What's the outlook for this year? Also, is democratization of the private assets a good thing for the sector? Our guest is Eric DERAM. Hello, Eric.
Hi.
You're the founder, managing director, managing partner, and CEO of FLEXSTONE. Thank you so much for being with us. First, a quick reminder of what is FLEXSTONE and how do you contribute to the private assets industry?
So FLEXSTONE is an investment manager dedicated to the private asset sector with a focus on private equity. We have approximately 11 billion assets under management, which are mostly bespoke programs for our clients, which are, the vast majority of them are institutional investors. So we build and manage investment programs for these investors that represent 75% of our assets under management. In addition to this, we have bespoke programs, so commingled funds, which are secondaries fund, co-investment fund, as well as niche fund of fund for certain categories of clients. We have a global coverage with offices in Paris, Geneva, New York, and Singapore. We have approximately 60 employees across those 4 offices. One thing that is important to remember about FLEXSTONE is we focus on the smaller end of the mid-markets. So for us, that means investing in funds which are between 150 to 1.5 billion on average. And when we do co-investment, we talk about enterprise value between 50 and 500 million.
Okay. And FLEXSTONE is an affiliate of Natixis Investment Managers. I don't know if I said it. Given the context on the private equity market in 2024, how do you see 2025? What's your outlook?
So optimistic, reasonably optimistic. So
okay.
24 obviously was a bit disappointing, right? We all started 24 very bullish about the environment, about the market. So what happened is the secondaries market was quite positive, 162 billion of transactions throughout the year. That is the record year. But if you look at M&A in the buyout sector, it has experienced the third decrease in 3 years, right, in a row.
Because of high interest rates, would you say?
High interest rate, uncertainty of the environment, geopolitical environment, the election in the US, which is obviously the elephant in the room. So all these factors combine to create an environment where the spread between bid to ask remained too high. Liquidity was not necessarily forthcoming, and therefore activity, generally speaking, has been disappointing. Fundraising was okay, but M&A, exits, new investment was again the third year decrease in a row. Now for 2025, I think we have a few things that have been clarified. One of them is the election, of course, in the US, but also the trajectory of interest rate is at worst stable, probably down, and that is obviously very positive for the industry in general. The geopolitical environment is still quite uncertain with China, Eastern Europe, with the war in Ukraine,
with France and Germany.
Some turmoil, political turmoil in France and Germany, absolutely, but also the Middle East. So obviously investors, regardless of the asset class, hate uncertainty.
Sure.
We're seeing a little bit of clarification of what is going to happen in 2025, and that is positive for business. Perhaps, the final comment is if we look at our numbers, we track the number of transactions that we see and we do, or the exits we have on a quarterly basis, and it was certainly up during the last quarter of 2024. So that's positive.
What are today's main issues for the private equity market? How challenging is the environment? You started answering this question.
Yeah, I think one thing we haven't talked about yet is the lack of liquidity. Obviously, because of the lack of exits and M&A activity generally in the market, LPs haven't received the cash back from the investments. If we look at our own program, even though we're in the smaller end of the market and that has not suffered as much as the larger end, because the debt environment was more positive for smaller transactions, we're still probably about a year, 2 years behind in terms of cash flow projections of cash coming back. And obviously our investors are waiting for this, in profits to come back before they can recommit to the industry. So this is, I think, the main issue going forward. The other issue, but I think we'll talk about it, is what's going to happen in the US.
Okay,
which
now,
is the largest market.
absolutely.
Right?
Now let's talk about the democratization of private assets. Can it come from the private equity?
I think, look, if you step back a little bit and you look at private wealth, I think most people already have private assets, and these are the real estate, the house, the flat, whatever, right? So, funny enough, investors are used, including private investor, are used to private assets and are used to illiquidity, right? I mean, what's more illiquid than a house or a flat, etc. So, now that being said, I think democratization is a very good positive trend for the asset class and for private equity in particular. Private equity is the largest, by far, subclass, if you exclude real estate, subclass of private assets. Private debt infrastructures are growing quite nicely, but it's still very substantially smaller than the private equity asset class. And I think it is easier to understand private equity. Everybody understands what stocks are in the public market. It's the same thing for private equity. Obviously, they're not traded, which creates certain constraints. But at the end of the day, you're investing and you're buying in shares of SMEs all over the world. And I think you're investing in the real economy. There's plenty of benefits for private investors that we can talk about.
Is regulation helping in that field?
Yeah, and I think it is a good trend. In Europe, for sure, in France specifically with the Loi Industrie Verte, but also in Europe with LTIF. But generally speaking, I think it is time for the regulator to recognize that private equity or private assets or private companies represent 80+% of the economy on a worldwide basis. And I think it is vital for the regulator to make sure that you and I, every individual investor, can invest in 80+% of the economy. So there's been a lot of movement from the regulator to facilitate that. Obviously, there are risks. We'll talk about it in a minute. Yeah. But I think it has been a good trend and a very positive evolution of the market.
Let's talk about it now. What are the risks of too much democratization?
So I see three main risks that are very important to keep in mind. The first one is professionalism. Second one is cost. And third one is liquidity. So if I take them in that order, professionalization is very important. Private equity is a real asset class which requires specific skills. And because of the democratization trend of private equity, a lot of people are trying to move into that sector. And we can see a lot of new offering product that I would not define as institutional quality. Even though you are selling to private individual, I think you need to remain institutional quality. So quality is one of the first issue. Second issue is cost. Private assets, it's a very active investment strategy. Private equity is among the private assets. And as a result, it is costly. It's costly also for institutional investor. But one has to be careful, and the industry has to be careful not to add a lot of cost layers just because this is going to be distributed to retail investors. Because at the end of the day, if you load too much cost into a retail product, everybody will be disappointed, and that will kill the goods, basically. And the third one is liquidity. Private assets, like we talk about real estate, these are illiquid investment strategy. These products, even though they have liquidity features, should not be sold as liquid product. I think it is very important to keep that in mind.
Speaking of risks, is the return of Donald Trump changing anything for the private equity market?
So it may or may not, right? If you look at history, we haven't seen a lot of impact, regardless of whoever was sitting at the Resolute desk in the White House. That being said, if you look at his policies, some of them could be extremely good for business in general, and therefore private equity. Again, 80% of the economy are private companies, and what is good for the economy should be good for private equity.
Pro-business.
Exactly. Deregulation is one of them, right? On the other hand, you have a lot of policies which seem to be very inflationary by nature. The tariffs, the immigration expulsion of a lot of low-cost, workers that could have very big inflationary impact. And in fact, if you talk to the Fed today, I think they're saying we're probably not going to reduce interest rate as much as we plan to. So we have to see, right? But I think the bottom line is, and the comfort is two things. One is, regardless of who is at the White House, it hasn't had a lot of impact on the economy and therefore private equity. The second thing is, I think the last Trump administration was called the mark-to-market administration. So President Trump looks at the stock exchange, and if the stock exchange goes down, he realizes that something is wrong, and therefore he changes policies. So I think the same thing is likely to happen in Trump 2.0.
And finally, any messages to the wealth professionals and their clients?
Yeah, I think,
coming here?
As I said earlier, right, private equity is a sub-asset class which has been around for a long time. There are numerous professionals of high quality who can offer very exciting products. So if we look at FLEXSTONE specifically, we've been managing evergreen program for institutional investors for 20 years. In fact, we're celebrating our
20th anniversary.
Yeah, in fact, I started the predecessor company exactly 20 years ago, 2 days, on the 31st of January 2005. And since then, we've been managing those evergreen programs. Whatever we do for the private client should have the same quality and the same investment process and rigors that we've been doing for 20 years consistently for institutional investors. And I think that is very important. And once you have that, you have the perspective of being able to build very diversified portfolio with probably very attractive returns as well.
Eric DERAM, thank you very much for your time. Partner, managing partner, CEO, founder of FLEXSTONE, which is an affiliate of Natixis Investment Managers.
Thank you.
Goodbye.